I recently started investing seriously. I now have both a private pension and an ISA, but it got me thinking, which is actually a better investment and why? I'm going to start with a summary. I'm going to use this video to explain why a pension is most definitely a better investment. Most of the time, depending on your circumstances. We're going to do this by looking at a few areas including taxes and contributions, regulations and protections for your investment, access, financial returns, and other, which largely boils down to choice. I will show you that despite making extremely generous assumptions in the favour of your ISA, it is still objectively a less good investment. Not just for you either, but for your children due to differences in tax treatment. Now there are some advantages to an ISA, to be fair, and it probably is important to have both. But we're going to work through this and I'm going to explain to you why the pension definitely works out better financially. If that's the only reason you started watching this video, then you can go away happy now. If you want to see the details, then stick around and we'll finish with a nice motivational quote from an ex-US president. Let's go. But before we move on, please like, and to keep up to date with all my content, please consider subscribing. Remember that each like means money toward our charity, St. Tiggywinkles, who help over 12,000 animals, including hedgehogs, every year. Here's a picture of my hedgehog Euclid. He's not in need of rescuing or help, but he's damn cool anyway. On to the work. An introduction to ISAs and pensions. So let's start with an overview just to make sure everybody knows what we mean by ISA and pension. So an ISA, first of all, there are actually 5 different types of ISAs. Stocks and shares, cash, what's called innovative finance, basically peer-to-peer lending, lifetime ISA, sometimes called LISA, and junior ISA, sometimes called JISA, I'm not sure, it's a junior ISA. Today we're going to be looking at stocks and shares ISAs specifically. They are designed to be tax efficient investment vehicles, and it's a use it or lose it offering. If you don't use your allowance in 1 year, you cannot roll it over into the next. It is intended to be more flexible than a pension. It's a built-in feature effectively. It is, after all, an individual savings account, not a pension. When we talk about pensions for this video, we're talking about a private or a personal pension. This is slightly different from an occupational or SIP, otherwise known as self-invest pension plans. There are differences in terms of investment options and, very importantly, actually protections. But for now, we can put that to one side. They are also designed to be tax-efficient investment vehicles, especially whilst working, though they do have different tax advantages to an ISA. And they're really designed so that retirement you can take a lump sum and then invest the remainder in what's called an annuity or a drawdown, or effectively cash it out. It's intended to build a decent stash for retirement and not be used before retirement. Now then, let's have a look at taxes. So let's look at ISAs to begin with. As I touched on previously, ISAs are incredibly tax efficient, but importantly, paid from net income, so after tax. So you get paid your wages, the government takes tax, and then whatever you're left with can be paid towards an ISA. However, and this is where ISAs really come into their own, all capital gains and dividend income is tax-free. Normally, capital gains tax for shares would be charged at either 10 or 20%. 10% if you're a lower taxpayer, 20% if you're a higher taxpayer. Capital gains does also exist on property as well if you're involved with real estate, 18 and 28% again for the tax differences between income bands, and dividend income is 7.5% for standard payers, 32.5% for higher rate taxpayers, and 38.1% for additional taxpayers, £150,000 or above income. So it does make a big difference. Pensions, meanwhile, are paid from gross income, so before tax, and the government will incentivize you to contribute toward your private pension by actually giving you the money you would have paid to them in tax as an additional contribution to your pension. However, all gains and dividend income is taxed, though only on withdrawal, and this is quite important actually. It makes a big difference. So you don't get any capital gains tax or dividend tax whilst you're continually investing into your pension. It's only at the end when you try and withdraw your money that you start paying. Now, there are some thresholds before capital gains tax and dividend tax begins, being £12,500 a year and £2,000 respectively, so that you can earn a little bit before having to pay tax even outside of the pension. There are also other exemptions, UK gilts or premium bonds, betting in general, lottery or pools. So there are things that you can do with your pension money or any money in general that will be outside of capital gains tax and income tax more generally. And again, with a pension, we touched on it previously, but it's specifically a 25% tax-free lump sum allowance from 55, so the minimum age when your pension begins, but that is being put up to 57 if you're retiring after 2028. So in short, both are tax advantaged, but the tax benefit is upfront for pensions, meaning less tax on earnings but tax on later income. But as you get a government contribution, and often an employer will contribute to your pension as well, you get significantly more money at the beginning, which can compound. And in a little while, we'll look through some examples as to see what the difference really is. So let's have a quick look at tax comparisons and see how they work. So this isn't my data, I've just got it from an independent financial advisor's, Flying Colours. I just thought it was quite a powerful way of showing you the difference up front. So this makes an assumption of £100 initial investment, 6% capital growth and 3% dividends reinvested. I think those are perfectly reasonable numbers basically. And what they've done here is they've looked at it, compared it to just a normal investment account, the first graph, the first line on the graph. Then they've looked at the ISA, and then they've looked at the benefits for both a higher rate taxpayer and a basic rate taxpayer. And you can see that regardless of your tax position, a pension works out better than an ISA. In fact, they went further and said that ISAs perform 25% better than a non-ISA, so absolutely top out your ISA if you're in a position to do so. But pensions are 33% better for a lower taxpayer, and they're 78% better if you're a higher taxpayer. Incredibly efficient, because instead of paying 40% income tax like you normally would as a higher rate taxpayer, that 40% contribution is put straight into your pension. So that's really what the difference there is. This is across a 40-year period. Now, I think this is a fine graph, but we're actually going to go a step further in a few minutes and really break down the journey from when you first make the £100 deposit through to actually your death and potentially transferring it to future generations. But I think this is a good immediate illustration of the differences. Let's look at regulation and protection. Okay, so let's compare an ISA and a pension. We're going to do exactly the same as we've been doing beforehand. So first of all, an ISA is protected up to £85,000 per person and per company under the Financial Services Compensation Scheme. What I mean by per person is if you're like me and you're managing both your own ISA and your wife's, you both get that protection, so £85,000 per person. By company, I mean that if you have £120,000 in an ISA, but it's split between Trading 212 and Nutmeg, then that's completely protected, because each company has their own protection under the Financial Services Scheme. So worth bearing in mind if you start getting near that threshold. Currently, you can contribute up to £20,000 per year with basically a tax year, so April to March. And upon your death, though, an ISA is counted as part of your estate. So that means if you're transferring it to your children, there will be inheritance tax on it, currently charged at 40%. There is one exception, which is if you're outlived by your spouse, then they can actually claim your ISA, keep it in a tax wrapper, and it'll be transferred over to them and keep all of the advantages that an ISA has, namely income tax-free when you're taking it out. So that is a nice caveat. A pension does work a little bit differently. So first of all, you have unlimited protection on your funds. It wouldn't matter if you had £10 million in your pension. If the provider went bankrupt, it's still protected, importantly. You can add as much as you like, actually. It's a bit of a misconception that you can only add £40,000 per year to your private pension. What it really is that the government will only give you tax relief on £40,000. So you can only get a maximum from the government each year of £8,000 if you're a lower rate taxpayer, and £16,000 if you're a higher rate taxpayer, 20 and 40%. There's also a lifetime allowance of 1.03 million. So if you've been fortunate enough to be able to make those contributions over your working life, the government will only give you tax relief on that first 1.03 million. So also worth bearing in mind. Also not particularly well known, but you can actually continue making contributions until you're 75, so long after you've retired basically, though only up to 3.6k if you're not working. And you'll get a government rebate all the same of 20%. It has to be 20%. So a guaranteed return of £720 per year, which I think is well worth doing if you're in a position to do so to get that free money. With a pension, if you die before you're 75, your pension will be passed on to your beneficiaries tax-free completely. If you die after you're 75, there's no inheritance tax on it, and they'll basically have to just pay income tax on dividends and capital gains tax. But the transfer itself of your pension is completely tax-free. So an important consideration between pension and ISA if you're thinking about generational wealth. Okay, so let's have a look at your access to your money. Okay, so comparing ISA and pension again, and I have to say, access is really where an ISA is undoubtedly better. With a pension, you can't access it until you're coming to retirement. It's a pension fund. With an ISA, however, it's a savings account, and you can access it whenever you want. Some ISA providers even allow you to withdraw and deposit in the same year without impacting your £20,000 allowance. However, Trading 212 is not one of them. So if you take out £1,000 from your ISA and put it in your invest account, you will only be able to top up a maximum of 19,000 that year. So worth bearing in mind. The main drawback though of using your ISA in this way is that once you take it out of the tax wrapper, especially for previous years, you'll not be able to put it back in again. So you'll lose some of the benefits of sort of compounding on those without paying tax on it. Lifetime ISAs or leases can only be withdrawn at 60 or to buy a first home, or if you've been diagnosed with that you're going to die within the next 12 months. That's also another way that you can get at it. Junior ISAs can only be withdrawn at the child's 18th or to benefit them. So think of private schooling or etc. Pensions, though, you cannot access until you're over 55 or 57 if you're retiring after 2028. I say cannot, but it is possible to access it via what's called pension unlocking. But typically, well, always, this will incur a 55% charge on your funds from HMRC and commission fees. And also, as well, the company that actually organises the pension unlocking fees aren't uncommon to see in the 20 to 30% range, meaning that you'll only get 1/6 of your money back. So it's a significant drawback. You can access it though with two caveats, either a serious illness, so similar to leases actually. If you've been diagnosed and you're expected to die within 1 year, you can get to your pension without those drawbacks. Or if you have something called protected retirement date. Now these are super uncommon now, and really it was before 2006 if you took this out. As an example, you'd have sort of a professional sports person would be expected to retire before they were 55. So you sometimes have sort of clauses that are linked in like that. You'll definitely know if you have one of these. They're super uncommon now, and like I say, the last evidence I could find was from 2006. And in terms of when you'll be able to get to your pension, the government has announced plans to gradually push back the age that private pension is allowed to be accessed and trail it behind state pension by 10 years. So as state pension has gradually risen, so will private pension, but there is a 10-year difference. But I guess this is where ISAs are so good, because if you're planning to retire, you know, as I'm hoping to at 55, then I will not be able to access my pension until I'm 57, so I need to do something for 2 years. So this is where, again, it's important to factor all this in when you're thinking about your own personal situation. Okay, so let's now have a look at the financial returns. Okay, so to illustrate the advantages, let's have a look at the journey of £100 and compare it between an ISA and a pension. First of all, I've just thrown up a box there in the top left corner, and you can see it whether we take a 10-year, a 25-year or 40-year checkpoints, basically a pension will outperform an ISA. And that's really because of the first consideration here that we're having to make. And by the way, this arrow is our life's journey. Everything above it is pension, everything below it is ISA. So we're going to start with a pension first of all. So we're going to take our £100 and we're going to assume that's 4% of our salary. Perfectly reasonable assumption to make, I think. Now, normally you'd get taxed 20% on that, but actually the government is instead going to add a contribution to your private pension as a result of you making a contribution to your private pension. And the way that this works is they're actually going to give you an extra 1% or £25. And the reason is you just have to get your head around it a little bit. But if you were earning £125, the government would take 25. So if you're contributing 100, they give you that 25. So just to think about it that way around. Also as well, because this is done for your employer, they will be making a contribution to it as well. So this 4, 1 and 5% here, that's actually what I do and have currently. So for every £100 I put in, I instantly get an additional £150, which is pretty fantastic if you think about the rate of return there. That will then be added to a pension pot, and it's going to grow at a net 8% a year, but it cannot be accessed as we've already touched on. The reason here for net is because a insurance provider, and it typically is who are managing pensions, they will take a management fee for it. Now, typically that's anywhere between about 0.3 and 1.5% if you're being really ripped off. I pay 0.7. We'll see in a couple of slides that it's the average is 1.09. But yeah, there will be a management fee behind it. But we're assuming that it's a net addition of 8%. Your money will then just continue to accumulate, basically, including if you leave your job, you don't pay anything more into it. It's still an investment pot and it's still going to continue to accumulate just like anything else would. And we're going to assume that you're retiring at 65. You chose not to retire at 57. You left your money in there a bit longer. Maybe you enjoyed working. But actually, the real reason is just so it's slightly easier to compare 65 with an ISA. So that's why we're simplifying it for this example. But when you get to 65, you decide that you're going to cash out 25% tax-free, as you should always, basically. And you're going to put everything into an ISA, so that 25% gets put into an ISA as well, and the rest is basically drawn down, and you get dividend on it of 4%. So great. As a result of that, you're going to receive £201 and pay 40% on the £150. So this is the 75% that you had to leave in there because you couldn't take it out tax-free, and it means you earn £140 per year in income. Not too bad. It also has the advantage that when you die, you're going to leave your child the capital amount. Now, it may or may not be 5,000. Chances are it's probably grown. But again, we're just simplifying things here just to make it easy for us to compare. They will actually keep 100% of the 3/4 still in your pension and pay 40% on the 25% in your ISA that you took out tax-free, right? That will leave them 4.5k, which, assuming they put it into a 4% dividend yield as well, will give them £180 a year for the rest of their lives. So a nice little gift there to leave on. If we compare that to an ISA, so actually you might think you're going to start with £100, but really you're starting with £80 because your £100, the government taxes 20%. So you only have £80 to put into an ISA. Okay, so £80 is then added to your ISA, and on the good side, you happen to be so good at outperforming the market that you actually get 10% per year. And I had to assume this because it's the only way I could make an ISA even competitive with a pension. But let's say you are really good, you can outperform the market, and you don't have any insurance management fees either, right, for managing your pension. So that is something. Like before, your money continues to accumulate even if you don't add to it. And by the time you've got to 65, you've kept your £100 in an ISA for 40 years. You can sell it if you want and not have any capital gains, but let's assume that you keep it and you enjoy the 4% dividend. That means that actually once everything is factored in, you're going to be having £132 per year, and that does save you £53 a year in terms of tax savings, so not too bad. It definitely does add up there. Okay, so you live till you're 85. That's a little bit generous, slightly above the average age, but you'll actually end up saving £1,060 in tax, and again receiving £130 per year. But when you die, you're going to be leaving that £3,300, and again, we were just assuming here capital growth was static for the last 20 years of your retirement. But that is actually going to incur inheritance tax, so you're only going to be transferring to your child £1,975. Or £79 a year if they're getting a dividend of 4%. So that is also worth considering as well, actually. Okay, so I appreciate that was quite a lot to take in, but let's go forth and have a look at a table comparing the two side by side. Okay, so if we now just simplify everything, you'll see here that an ISA you started with £80, your performance was 10%, there is 0% management fees, and I've also here again, just to give the ISA a fighting chance, assumed that your income tax bracket to start with was £20. That's an important consideration because if it was 40%, then you just get a further advantage by putting it into a pension. So just to give an ISA a fighting chance, we're going to assume that when you made the investment, you were in the lower tax bracket. Your value at retirement here is 3.3k, and your retirement income £132 because you have no tax on it. So great, and your kids are going to inherit £79 per year in terms of income. Pension, meanwhile, you actually start with £250, and really this is where pension is better purely financially than an ISA. The bigger amount to start with just means it has longer to compound from a larger amount, so that really does make a big difference. If you think about it, it's 3x on your ISA, right? 80 times 3 is going to be 240, so straight away you're starting so much further ahead, and even over such a long period of time as 4 decades, and even though the ISA here is outperforming the pension pension in terms of its yearly performance, it just doesn't have enough time to catch up. It's too far behind from the beginning. And again here, just to give an ISA a fighting chance, I'm actually assuming here that in your pension you've invested so wisely throughout your life, and now your income is so great that you're in the higher tax bracket. And again, if you're not, then the pension is just even better, because income tax now being applied to you is actually lower rate tax. So again here, by assuming that you were paying 20% when you were working and 40% when you're retiring, which is pretty atypical really, normally it's the other way around, but let's make that assumption just to keep things a little bit competitive. Still, the value at your retirement is just significantly more than an ISA, more than 50% actually, so really significant. And you can see here, because you do have to pay tax on it, and in this assumption you're having to pay 40% tax on it, you only actually slightly outperform. It's £8 additional per every £100 that you've invested, so not a huge amount. But again, if you're starting to think about generational wealth, your children are going to get twice as much benefit from you having your money in a pension. Okay, so let's have a look and see if there's any other considerations between an ISA and a pension. So for me personally, when I think about other, it's really about choice. And there are some important considerations here between an ISA and a pension. So an ISA, first of all, offers you the ability to pick individual shares, which may appeal. Certainly for me, I would even be willing to underperform the market if it meant I could have the fun of picking individual shares and seeing how I performed, etc. That's part of the excitement for me. There are no management fees. And increasingly, it's a zero-cost trades environment. Again, I have Trading 212. It's great not having to pay for share dealing. And also, ISAs can be easily moved, though you can only have one ISA per year, so you'd have to wait before consolidating. Again, that may well appeal. With pensions, these are actually usually held by insurance companies, and as standard, they will hold them in very risk-adverse long-term accounts. I very recently, and I mean a month ago, put in the effort to organise 3 different pension funds, 2 for me and 1 for my wife. The reason I have 2 is because I consolidated previous employers, and then I have my current employer, whereas my wife has only had a pension really for 1 employer, so that's fine. So yeah, when I had a look at those pensions, they were in such risk-adverse bonds and low-risk ETFs, etc. We just weren't really optimizing them. So if your pension provider does offer you a portal that you can go in and make some changes, honestly, make sure you do, because as standard, these are very risk-averse organizations, and you might not be optimizing your long-term return. Although your employer will have a dedicated pension provider, and they must stick with them really. Again, once you leave, you can transfer them. And actually, I would say transferring an ISA and a pension is broadly speaking similar. It's just in terms of who you're actually going with that's different. So, but both of them are relatively painless, and I've done it myself quite recently. Now, I touched on this earlier as well, but there will be management fees, and these can be anywhere between 0.3% and 1.5%. According to lovemoney.com, the average is 1.09%, and again, I'm currently paying 0.7% with Standard Life, so I'm somewhere in the middle, presumably. There can also be transaction fees and transfer fees and so on. Often these aren't big in isolation, but they can certainly add up as well. And again, if you compare that to the transaction-free world of ISAs typically now, that can also make a big difference as well. So just in terms of choice, actually I would say probably ISAs win it out. Okay, so in conclusion then, a pension is better, at least financially. You get the tax relief on the initial investment, means you get a bigger figure to start snowballing. Get employer contributions, can be pretty significant. Also, again, means the start of a bigger snowball. You get protection from 40% inheritance tax when passing it on to children. So again, if you're thinking of generational wealth, an important consideration. And also, although we didn't touch on it a huge amount, just because it needs a video of its own, you can actually quite optimally manage tax and capital gains in retirement. Realistically speaking, there are a number of ventures or options that you have to really minimize and reduce the cost of having a pension compared to an ISA as well. Another advantage to a pension is you have unlimited compensation from pensions. Now, as long as you're reasonably sensible with ISAs and kind of limit your exposure, you should also be fairly protected, but it's just an extra hassle if you're having to manage sort of 10 different ISAs. Now, in fairness, when it comes to access, an ISA is way better than a pension. Pensions just aren't really intended to be accessed before retirement. Even with LISA, which I know we didn't really look at because we're looking at stocks and shares this video, but even with a LISA, you can take it out with a 25% penalty. So even that, which is the one ISA that has limitations, is much less penalizing than taking out a pension early. Now, in fairness, with financial returns, it is likely to be better over the long run. Like, sure, if you're Warren Buffett and you can outperform the market significantly, then there might be some advantages to it. Also, as well, if your management fees from your pension provider are particularly excessive, or so on. But realistically speaking, you're just likely to do better in the long run. And really, that's all about the snowballing that's allowed to happen at the beginning. I would say if choice or being able to pick individual stocks is a big thing for you, then certainly an ISA is better than a private pension. Interestingly, SIP, and again, we didn't look too much at that pension in this video, does have some advantages here compared to the pensions that we have looked at here. But broadly speaking, most employer pensions, private pensions, personal pensions, whatever we want to call them, just the options of funds available just aren't as good. I've never seen a portal that allows you to do individual shares. The best ones do allow you to do ETFs and can be quite broad in what they can do, but as standard you'll be set up with a very basic risk adverse account. So all of these things something to consider. Broadly speaking though, again, if you're just looking at the financial performance, a pension is going to win all the time. And I guess a recommendation for everybody, but you know, I'm recommending this to myself as well, is to put yourself in a position where you have the flexibility of an ISA, where you can use it for a couple of years if you need to take early retirement, and where you have some cash and or an ISA available if needed. But once you're in that position to actually really go hard on a pension, just that initial top up is super significant. Any other investment, if you were getting 150% guaranteed from day one, would be an investment that you just never turn down. And really the main drawback for having a pension is the fact you can't touch it for decades. But that really is the only drawback that isn't manageable. So that's just, I guess, not financial advice, but it's my opinion. It's what I would recommend if you care to listen. But yeah, so I hope you found that enjoyable. I personally found researching this super beneficial for myself, and I'll be looking to go forth with that recommendation. Thanks very much, everyone. But before we go, I believe I promised a quote. This is one of my all-time favourite quotes. It's from Lyndon B. Johnson. Yesterday is not ours to recover, but tomorrow is ours to win or lose. I just love it. I think it's really a great way to kind of move on from regret, not dwell on it too much. I wish I'd started investing 10, even 15 years ago and I didn't, but so what? Tomorrow is ours, and we just have to make sure that we make better decisions moving forward. So I really like this quote. I think it's worth bearing in mind throughout life's journeys, so that your regrets don't consume you, basically. All right, good luck, everyone.